Let's get to our first guest this morning, Jeff Henriksen, Thorpe Abbots Capital CEO and University of Oxford Senior Fellow. In your words, sir, equity's still the best pond to be fishing in. Why, Jeff?
Yeah, thanks for having me, guys. It's been a great time listening to you guys talk about everything. So I think we look at asset classes. We don't look at asset classes as some monolithic security that you need to either embrace or avoid. We look at every asset class as an opportunity set. And when we take a look at the market today, we think equities, while headline valuations might look expensive, still provide the best opportunity set for investors to find, places and ideas to place capital. That said, I think it's becoming more and more of a stock picker's market. I think you really have to understand the types of businesses you're buying, the valuations at which you're buying them. But if I had to pick one asset class that I want to be spending time diving into and really learning where I can find mispricing, equities is still that asset class. And I think that is a function of where we are with the recovery, although we've seen some headwinds recently that we can talk about, but recovery is still in place. You have inflation running hotter than most people would like to see. And yet you still have, what is it, $4.5 trillion and stuck in money markets still. And I think I saw the other day that negative yielding assets, dollar assets globally are now back around like 17 trillion. So kind of where we are vis-a-vis the recovery, I think markets are still off sides here. And I think capital's incrementally going to go to equities.
Buried in your note, you talk about PE compression, where we get the ratios that we all look at compressed in. John Golub, who's at 5,000 SPX, feels the same way. How much can PE compress?
Well, I mean, they could compress. I guess my concern with PE compression really is around inflation, because the worst possible environment for stocks, in my opinion, and I think history proves this, is a period where you have slow growth and high inflation, a stagflation type of environment. And I think, in the 1970s, you saw PE ratios go from, I think like in the 60s, around 18 times to below 10. And that's because inflation is very value destructive. And so I think part of the potential for compression is going to be a function with what happens with inflation. But that said, I think a lot of companies are, I don't know if I buy the idea that the S&P multiple is meaningful in any way. And the reason for that is I would say twofold. I'd say one, if you look at historic multiples in the S&P, you have to look at historically, what's the S&P been made of? Well, if you go back, 10, 15, 20, 30 years, I mean, industrial companies, a lot more commodity exposure, very capital intensive businesses. Whereas if you look at it today, the composure is much more heavily weighted towards tech, which, by the way, does a lot of investing through their P&L. So, I'm not even sure if earnings are a meaningful number to put a multiple on for a company that's growing rapidly and investing a lot through their P&L. I mean, we're expensing the costs to go out and acquire a customer, but those customers have very long lives and they can be very sticky. And there's an argument that you should be capitalizing those costs. So multiples are a tricky thing. And I think you have to keep an open mind with how you look at it.
All right. So, Jeff, how do you then evaluate companies that you see as particularly good stock picks?
Well, I think we look at two types of situations, right? We're focused on either finding what we'd say are really traditional value trades or mean reversion trades. So assets or companies, equities and companies that are trading just meaningfully below what they're fundamentally worth. And then we try to find higher quality wide moat businesses where we think the growth component and the reinvestment opportunity that the company has is misunderstood by the market and mispriced. So those are the two buckets we look at. Last year, that first bucket is where we found all the opportunities. Right now, most of those have already mean reverted. I'm not seeing a lot of opportunities in the deeper value part of the market. What I'm finding more opportunities on are kind of smaller growing businesses where I think that growth opportunity is mispriced. So how we try to evaluate that is we try to identify what is the true reinvestment opportunity and what's the true amount these businesses are really reinvesting. So we try to look at the P&L and we pull out expenses that we think should be capitalized, reconfigure their income statements and balance sheets to try to really get an understanding of the incremental returns that they're earning and the value that they're creating. And to do that, you can't just apply a multiple to a bunch of companies like it's some monolithic thing. You have to get in and understand the economics of those businesses to do that. And so that's why I say it's a stock picker's market.